Alright, picking up from where I left, cash flows from investing activities. Under this heading, we look for any purchase or sale of equipment. The question gives you an additional information that equipment costing 37,500 was sold for cash proceeds of 10,900. So sale of equipment has already been given to you. Sale of equipment is worth 10,900. Any sale of fixed assets increases the cash flow. So this will be added under the heading cash from investing activities. As you can see here, sold equipment 10,900. Now for purchase of equipment, you first want to go to the balance sheet and check for the equipment. It was 88,000 in 2004. We always look at the cost and not the net book value. So 88,000 was the equipment in 2004, and it has increased to 127,600 in 2005. Which means that there has been an additional purchase of equipment, but we have to figure out the cost of the equipment purchased. So your working note will start from the equipment which has been sold. So what you will do is you will take this figure of 2004 as the beginning balance of your equipment. So let's get on to the working note. This is the calculation for purchase of equipment. We start with the equipment ending balance, which means the equipment in 2004. So the equipment in 2004, as you can see, was 88,000. And then from this you will deduct the equipment which has been sold to arrive at the remaining equipment in 2005. So the cost of equipment which has been sold is 37,500, which is given in the question. If you look here, they have already given you the cost of the equipment. The cost of the equipment purchased, the equipment sold was 37,500. Equipment costing 37,500 was sold. So the cost is given to you. You do not have to calculate the cost, unlike the question 1. So what we do is we deduct the equipment sold from the equipment balance in 2004. We get the remaining equipment in 2005, which is 50,500. The equipment remaining in 2005 or during 2005 was 50,500, but the equipment or the value of the cost of the equipment the cost of the equipment at the end of 2005 is 127,600. So we will deduct 127,600 from the remaining equipment in 50,500 to arrive at the equipment purchased in 2005. To repeat my explanation, we need to calculate the cost of the equipment purchased in during 2005. For this, we first start with the equipment ending balance in 2004, which is 88,000. From here, we will first deduct the equipment which has been sold. So we take the amount at cost, which is 37,500. When we do this, we get the equipment of the cost of 50,500. But the equipment which is shown by the balance sheet at the end of 2005 is 127,600. So which means the difference between 50,500 and 127,600, which is 77,100, is the cost of equipment purchased during 2005. So equipment purchased results in decrease in cash flow. Therefore, in our cash flow statements, we record the purchase of equipment minus 77,100 as we got in our working for the purchase of equipment. Now there is no other purchase or sale of any other non-current assets. So 10,900 minus 77,100 gives us minus 66,200. Since it is a negative amount, therefore it is cash flows used by the investing activities. And then we proceed to record the cash flow from financing activities. For financing activities, we will look at the long-term liabilities as well as the shareholders' equity. Long-term notes payable was 48,000 in 2004, which has increased to 83,000 in 2005. Any increase in long-term liability or in current liability results in increase in cash flow. So we will add this to under the heading cash flow from financing activities. As you can see here, issue of long-term note 35,000, which is the difference between the 2004 and the 2005 number. And then we look at the common stock. The common stock in 2004 was 125,000, which has increased to 161,000 in 2005, which means there has been an issue of common stock or common stock sold, which again increases the cash flow. So we will add the issue of common stock in the cash flow statements. Issued common shares 36,000. 36,000 is the difference between 161,000 and 125,000. No other long-term liability or issue of common stock. Now we will check the difference between the beginning retained earning and the ending retained earning to get our figure for payment of dividend. So to calculate the payment of dividend, the working note, you start with always the beginning balance of retained earnings. So the beginning balance of retained earnings in 2004 is 94,500, as you can see here in the retained earnings in the balance sheet. It is 94,500. To this you will add the net income, which is given in the income statement. That is 59,000. You can see here. So 94,500, which is the retained earnings beginning balance in 2004, plus 59,000 net income gives us 153,500. From 153,500, you will deduct the ending balance of retained earnings, which is 103,800 in 2005. So 103,800 minus 153,500 will give us the amount of dividends paid, which is 49,700. We record this in the cash flow statement under the heading cash flows provided by financing activities, paid dividends minus 49,700. And now we will record our final figure under the heading cash flows from financing activities, which is 35,000 plus 36,000 minus 49,700, which gives us minus 21,300. Since there's been a mistake, it's plus 21,300, and since it is a positive figure, this is cash flows provided by financing activities. Once we have got all three numbers under the three headings, that is cash flows provided by operating activities 26,700, cash flows used by investing activities minus 66,200, and cash flows provided by financing activities plus 21,300. This gives us an amount of minus 18,200. Since it is a minus amount, it's a net decrease in cash, to which we will add the beginning balance of cash, which we bring forward from the balance sheet. As you can see, beginning balance of cash is 61,300. So 61,300 is our beginning balance of cash, which we add to the net decrease in cash. So minus 18,200 plus 61,300 gives us an ending balance of 43,100. This amount must match with the cash balance of 2005 as given in the balance sheet in the question, 43,100. So that is the solution for Clearwater Company.